Good afternoon. I'm Brent Wilsey. With me is Chase Wilsey. We're from Wilsey Asset Management, and welcome to the Monday edition of the Smart Investing Daily Briefing. Today we're talking about 100-year-olds. Well, they're booming in the U.S. Actually, 72,000 have doubled from 20 years ago. And the Census Bureau predicts that centenarians will grow by 2050 between 265,000 to as much as 4.2 million centenarians. That's a huge growth in the population.
Oh yeah, it's not the feat that it used to be. It's becoming more and more common. And it's really interesting looking at these past numbers versus what these estimates are actually trying to predict. As you can see, the Social Security Administration estimates that 1% of those born in 1910 actually made it to age 100. And as of today's day and age, it's estimated that 50% of girls born will actually make it to that milestone of 100 years old. Wow. I mean, half of them really not a milestone anymore. It's kind of the average common occurrence. This is due to things like medical care, not smoking. When smoking first came about, no one really knew, oh, how bad is it for you? Now I know it's bad for you. And also weight control, living a healthy lifestyle are things that will contribute to those making it to age 100.
And this all shows you how important it is to invest properly, because you're going to be in retirement for maybe 30, 40 years. It's a long time if you're living, and actually people living at 110 right now too. So again, you're in retirement for a long time. You have to learn how to invest properly and not lose your money by investing.
Or you got to make sure you have a nice nest egg that you can pull from when you're retired.
Exactly.
That'll be your source of income.
Long income, yeah. So currently today is Michael's company. Current price around $27.56. The high $31.36. The low $19.46. It's up and then down and up and down. Let's see if right now the Michael's company is a buy for you. Sales are up 4.8%, looking pretty good. Earnings rose by 78.4%, so those are positive things. But what kind of worries us a little bit is a quick ratio, which tells you the capability of them paying off their short-term liabilities. Not very good. It's only 0.36. And the debt, while it's improving, now about $2.7 billion, down from a year ago, $3.1 billion. Still a lot of debt on the balance sheet.
Yeah, and think about what they could be doing instead of paying down that debt. They could actually be improving the business. And also, this is the most worrisome part of this company. As you can see here, equity is negative $1.68 billion. So we can't get a price to book value, no price to tangible book value, no debt to equity, because quite simply there is no equity in the company. I will say this is a slight improvement from a year ago. It was negative $2.03 billion, so that slight improvement to less negative, I guess, is a positive. Going forward to January 2018, estimated earnings per share on a GAAP basis, $2.18, gives a target sell price of $35.97. And while this does look appetizing from the current price, there's still a lot to be worried about here with this negative equity, and it's important. Don't just look at earnings. You have to understand the whole company.
Right. Yeah, it looks good, but make sure you understand it and be patient with this company too. So, well, I hope you enjoyed today's edition of the Smart Investing Daily Briefing. If you'd like to receive a free report on the 5 big mistakes investors make,
give us a call here at the office at 858-546-4306. And if you've missed any previous Smart Investing Daily Briefings, go to our website, smartinvesting2000.com.